So I'd like now to welcome Bob Kelly from Microsoft, joining us from Seattle, and Bill Murphy from Enterprise Angels, who will be moderating this session on selecting potential acquirers.
I'm going to talk just very briefly because the quality of our panelists here is so high. I just want to leave all the time to them. But I just want to position this a little bit in terms of the industry here in New Zealand. We've started off with a hiss and a roar. We've done fantastic work establishing angel groups, making initial investments, and that's all been great, really exciting. The last couple of Angel Association conferences, we've really started focusing in on exit, Basil Peters' approach in his book. But as we oftentimes say to the CEOs of our investee companies, it's all about execution, boy. We're at that point in our life cycle as angel investors now. If we look behind us, you know, we've got 40, 50, 60, 70 companies that we've invested in. And if we also look behind us, we don't have a lot of companies on a strong exit or acquisition path. So we've heard about exits. We know how important they are. Today's session is going to be maybe the kickoff for us into the next phase of our growth, which is all about implementation. And having actual acquirers here and advisors of acquirers is going to give us a great insight into what are these guys looking for and how do we engage with them. So I also want to introduce our other two panelists that are with us this afternoon. Frederick from GrowthPoint Technology Partners, Australia, and Johan Smet from Trimble, New Zealand. And you've got their bios in your program. If the name GrowthPoint, of course, Microsoft will sound familiar to you, but if the combination of those two together sounds interesting and to you, you might remember that that Green Button's exit was facilitated by GrowthPoint, and Microsoft was the acquirer, and Bob is very involved in that acquisition. So it's great to have actual experience here with one of our major exits. So with that, I'll let our panelists take it away. Bob.
Thank you, Bill. Thank you, Marcel, for finally convincing me to come to this lovely land of yours. Beautiful. Bob Kelly, 20 years or so at Microsoft, mostly product management for our server business and our cloud business. And now over the last 3 years, our M&A strategy and commercial deals for the cloud and enterprise business at Microsoft. About $25 billion of revenue to the company. What I wanted to do before I jump into sort of my thoughts on acquisitions, if this clicker will work, is bring up a couple slides just to frame the dialogue, okay? And I'm going to explain to you through the lens of this slide here how Microsoft thinks about our cloud business, because it's extremely important to understand how we think about it in order for you to understand how to engage with us, okay? Across the cloud and enterprise business, there really are 5 missions that we are on. The first is transforming the data center. And really fundamentally what that means is helping large customers and small take advantage of these new capabilities of the cloud. And we believe at our very core that large customers are going to be hybrid. They're going to have assets that are on premises, and they're going to be consuming cloud services. And this data center rewiring, the rebuilding of the modern data center, is really architected for massively scale out. You know, the old generation of scale up is is the old generation's legacy. And so scale out architectures are now fundamentally changing the way that infrastructure is provisioned, that compute storage network is consumed, and the hybrid nature of the data center, thinking of the cloud as a node on your data center. Okay, that's sort of what transforming the data center means. Unlocking insight on any data. Fundamentally, this is around BI and analytics. And we have massive investments in this space. And really, you know, if you start to think about the massive changes that have happened in the industry over the course of the last 30 years, almost every time it's been around input-output, right? The mouse, touch. Well, you have new things coming into the market now around voice, around interaction, around HoloLens, and how you interact with data. Massively transformational for customers as they begin to start to take advantage of those capabilities and technologies. Empowering enterprise mobility. The user has never been more at the center of their own universe than they are today. You know, it's now not just BYOD, it's BYOC, bring your own cloud, bring your own apps, bring your own everything. And the user really is at the center of that, and we want to empower that user to be at the center, while at the same time giving IT the control and the governance that they need to run business, so you don't have risk. Okay, so massive investments in this arena. In fact, in this arena, we have a product that is the fastest growing product in Microsoft's history, the Enterprise Mobility Suite. We will grow another 300% this year. Massive business for us. Creating the Internet of Your Things. Obviously, IoT is on everybody's mind, and you hear this from every technology company that it's a part of their agenda. We do believe, because of the breadth of our scale, the endpoint knowledge that we have, security management capabilities, and insight, that we can actually build the most robust and give customers the most robust platform for the Internet of their things. Everything is connected. And in a world where everything is connected, you need to be able to both manage that and derive insight from it so that you can have new businesses. And that's the mission we're on there, is to help customers build new business from their Internet of Things. And finally, enabling application innovation. This is really fundamentally about how do we ensure and help developers build new things, right? And that's not just on our stack. If you know anything about Azure, one thing that you'll know is that we support, in a first-class way, Linux, PHP, Java, MySQL, because developers need to be met where they are, not where we want them to be. We've got to meet them where they are, particularly in the cloud. The cloud is, everything is just an API call away. So we need to fundamentally sort of rethink what it means to enable application innovation. That's how we think about our business. The second insight I want you to derive from this is, each of these is a sales motion for Microsoft. In transforming the data center, we have a massive investment in sellers who actually, their job is fundamentally to go help customers transform their data center. Same with unlock and insight any data. And the two kinds of sales motions. One is horizontal. We try to sell it to all the users and all the systems. And one is project-driven. So app innovation, unlock and insight, those are more project-driven sales motions, and we have project-driven sellers. And then the others are more horizontal coverage, account teams, okay? That's important as well, because what I'm going to show you in a moment is the acquisitions that we've done over the last 3 years that I've been on the business. The reason I show you this is because we're not buying new go-to-markets. We're buying capabilities, technologies, companies, and people that accelerate our ambitions, that change the vector of the path that we're on. But we are not buying new go-to-markets. So don't come and pitch me on how to think about a new business. That's not what we're about. This slide here is a fascinating one to me. Most people think that Microsoft, if we're acquisitive, are acquiring US-based companies. There are a few things to note. One is, in this time frame, this is about 3.5 years since I've been doing this for Microsoft, we've acquired 23 companies. The prior 10 years, the server division had done a total of 25 acquisitions. So we are much, much, much more acquisitive. These 23 acquisitions are in excess of $1 billion of cost to us. Okay, we've spent real money buying companies. In fact, like the little green one down there in the corner, which was a super fun experience, I think, for all of us. One of the things that's really important, sort of for me at least, as I think about what we're doing in the acquisition space, more than 60% of our acquisitions have been outside of North America. And there are a couple of note that Adalom and Erado, those were our first Israeli-based acquisitions out of our division in probably 15 years. And that has its own dynamics, okay? But the core of my message to you here today is understand, one, we are acquisitive. Two, that we want to engage with the ecosystems early and often. Three, bring us ideas of companies that are actually aligned to our sales motions. Four, don't wait to have the dialogue. If you wait too long to have the dialogue with us, one of the things that the green button exercise taught us was we were engaged extremely early, and we did a bunch of product level integration that when we decided to acquire, we were already way ahead of where we could have been. Okay, so those are some ideas and some thoughts from us, and then I'll kick it over to, I think you're up next, and then we'll go from there.
All right.
Thank you.
Thanks, Bob. Thanks, Bill. Thanks to the whole team here, by the way, for having us over here. It's a wonderful event. So I'm Johan Smet. I'm with Trimble Navigation. I talked to a few people out there, and they seem to have some idea of who Trimble Navigation is, but I'll give a quick introduction. So we're a technology company. We're about $3 billion, so quite a bit smaller than Microsoft, but still quite a bit larger than a lot of the companies we talk to and look at. We hold our own. We have about 8,000 people. We do business in pretty much every country where it's legal for us to do business as a US company, so about 157 countries, I think. And we have R&D and development centers in about 35, 40 countries, mostly as a result of acquisitions. We tend to acquire and then build. We don't sort of blow it up after we acquire it and strip it of everything but the IP. That's kind of what we do. The industries we play in we have a very vertical approach to how we go to market. We look at industries, and our big corporate slogan is transforming the way the world works. What that means is we'll look at an industry, typically an outdoor activity industry, such as agriculture, civil construction, building construction, mining, aggregates, transportation, and logistics. Those are the big five, actually, that we look at, and we'll say, okay, what are the core business processes? How do these people make money? What makes them tick? What makes them competitive against their competitors? And then how do we apply technology to make those processes more efficient, more effective? And technology can be anything. For us, it usually involves software, some sort of on-premise or cloud-based system, but also communications technology, radios, et cetera, and in-the-field sensors. A lot of GPS, thanks to our history, but also lasers, image recognition, fuel sensors, temperature sensors, whatever senses the information that we need to provide the analytics for the customers to be successful. So that's what we do. Our strategy, like I said, is very, very vertical. So when we're looking at acquisition targets, we're going to look at companies that help us with that strategy. Actually, like the way Bob said it, anything that can accelerate or change the vector of how we are being successful in our strategy. Our strategy is already defined. We don't need you for that. What we need is a company that's going to help us accomplish that strategy faster or more effectively. So that's the kind of company we look at. It also means that oftentimes or pretty much all the time, these targets are going to be in adjacencies to industries we're already in. So the industries I mentioned, we're not going to look at anything in healthcare or biotech or anything like that, right? We're not a holding company or an investment company. We're a commercial company. So my role in that whole thing is I'm actually not involved in the acquisition process at all anymore. I used to be more involved in due diligence, but I'm a general manager of a division. So I'm the kind of person who brings to the acquisition team an opportunity and says, that's a company I'd like to go after, or this is a kind of technology I'm looking for. Can you help me identify companies that do that, who are the leading players in their field? So that's one element. So I help with the decision-making process and the due diligence from that point of view. And then afterwards, I'm also the recipient of the acquisition. So I have to live with it after we acquire it, which is quite an interesting role as well. So and that's actually what brought me to New Zealand, by the way. I'm now running a company that we acquired in Auckland about 2 years ago, which is a great experience and opportunity. So that's what I do. That's what Trimble does. In terms of what we look for in acquisitions, there's a couple of things, right? Not unlike Microsoft, I think, maybe even a little bit further later stage, if you will. We're looking for companies that actually have a proven and a viable business model. We're not looking for new breakthrough technology that nobody has bought yet. We want to see real customers. We want to see a real commercial model. It doesn't have to be big, but it has to be real. There have to be real people that paid real money for an actual tangible product, or a software product, obviously. It doesn't have to be huge. It doesn't have to be worldwide. It's not the size that matters. It's the proven solution to a real world problem. That's what we're looking for. So that's one thing, and it has to be profitable intrinsically. So it has to have a proven price point that justifies the amount of sales effort that goes into it, support effort, et cetera. So the basic economics of the business model must work. We like the company to be profitable, but it's not necessarily a given as long as there's a clear path to how are we going to make this thing profitable. We are a public company. We have quarterly reports that we have to file, and we have a CEO who really, really wants us to be profitable and grow our revenue. So those things are important for us as well. So that's the first thing that we definitely want to see. Second thing we want to see is technology, clean and clear technology. So a couple of things about that. We like products that are actually modern and up to date, not something that was developed 6-7 years ago and that runs on an operating system that's about to go end of life. But the investors or the owners think they're being smart by milking the business, by reducing the R&D effort and making it look like it's really profitable. We're going to notice that, right? We're going to look at that and say, okay, well, this is old. Now we're going to have to plow a couple of $1 million into bringing this up to speed. Honestly, we'd much rather have you do that and then come to us with a modern and up-to-date product, because you know how to do that much better than we do. We don't want to own that problem. We don't want to buy that problem. We want to buy that solution after it's done. And we'll pay more money for it. That's not the problem, right? In fact, actually, you'll get a better valuation if you do that. So that's about modern. Then we also want it to be clean in terms of IP ownership, in terms of the use of open source code, et cetera. Needs to be extremely transparent and very well documented, because that's a huge potential IP liability for us. If there's hardware involved, we want the products to be certified. We want them to be RoHS compliant, conflict minerals, all those sort of legislations. It's worth investing in to make sure you understand what you have and don't have, because otherwise, again, we will have to do that. It costs us money. We have to solve it. That all comes out of your valuation. We'd much rather pay for that already being done. I was thinking about it before, and I think a good picture to keep in mind is, for us at least as a company, maybe not everybody is like that, but we don't like to buy fixer-upper houses. We like to buy something that's been remodeled and that's clean and has a fresh coat of paint on it, and then, we'll pay more for that. And that's fair, that's legitimate, we understand that, but that's what we like, because then we can move in and we can start our life together. We don't have to first gut everything and rebuild it. So that's on the business model and the IP. The third thing I'd like to say is on culture. We need to understand, people need to understand that life in a public company is very different than life in a private company and in a startup. There's a lot of decision-making processes. Life is going to become ambiguous and sometimes burdensome, and that's just how it is. There are certain regulations that we have to live with that you didn't before, so you got to understand that. And then the last bit, I think, is something that's often overlooked in smaller companies, is the business processes. The financial infrastructure in a company is very important to us too. We'd like to come in and we want to see that there's clear processes. You have audited financials, your contracts are well written, they're standardized, they're not all over the place, there's not all gaping wounds in them. You have something like VSOE when you have a product, so we can actually recognize the revenue that we just invested. There's a lot of these factors that I think a lot of technology founders don't think about, and it's hard to clean that up afterwards. And I was talking to my panel friends here earlier and saying, I think that's one of the big values of having a private equity investor, that they really understand that kind of stuff and they can help you with that. So those are the big things we're looking for. Things that we don't like is, of course, the opposite of all of that, not having a business model, not clear ownership of IP. But also some of these things like non-arm's length transactions is something that tends to delay deals. It's not insurmountable, but it's a pain in the neck, right? When there's like a building that's owned by the founder and you have to sign up a lease for some exorbitant rate because he wants to keep extracting money out of it. Or there's weird compensation schemes that are completely out of the market. There's better ways of handling those desires of the owners to take money out than trying to do it through some sort of odd scheme, so we don't like that. And then obviously things like pending liability or competitive situations that have not been resolved or are not clear, right? Because again, we have to devalue the deal for that. So that's about it. Vertical industries that fit with our strategy, a clear business model, and clean technology, I guess, are the big takeaways.
Thank you very much, Johan. So we've heard from two potential acquirers there. And now what we're going to do is we're going to move on to hear from an advisor to the industry who may be the type of person or type of company that would work with us to help to enter into conversations with acquirers like Trimble or Microsoft. So Kara, kick us off on that.
Thank you very much. So I'll touch on 3 points. The first is just, who are we? GrowthPoint Technology Partners is a US-based, Silicon Valley-based, technology-focused investment bank. We have offices in London, and I run the Australia-New Zealand office with a team based in Sydney. We think we are the only middle market tech advisors, US-based, that have people on the ground in Australia and cover New Zealand as well. So we like to think that we know this market a little bit better than maybe some of our competitors. And I can take questions in Q&A around how I might think there's similarities and differences between New Zealand and Australia and the US. That's sort of the first point on who we are. My own background is I don't have an Australian accent, but I grew up in Silicon Valley, and I've been on the buy side and the sell side in public and private markets in the US and Australia. Primarily tech throughout my career. So I have kind of a varied perspective. But on the deal side and in an advisor capacity, what's our job? Our job is to service our client and get the best outcome for our client, and to get an outcome, which means that we also need to be able to work well with the other side of the table. And because the majority of our transactions as GrowthPoint are cross-border, we believe that this is an area that we are particularly skilled at. So when it comes to whether it's the green button transaction or others that we've done, it's probably about 20% of our global pipeline is Australia, New Zealand. So as I said, this is a material focus for us. So we need to be effective with the other side of the table to get an outcome while representing our clients' interests first and foremost. So I think it's been good to be able to listen to a couple of acquirers, strategic acquirers, but taking just a level up, that sort of 30,000-foot view. Strategics are not the only acquirers, of course. There's financial institutions, such as private equity firms or venture capital firms, as well as strategics. And then not all strategics are created equal, because there's a variety of strategics, public, private, and some of the points that were just mentioned earlier, even among these two strategics, there's material differences in terms of what they're looking for. So my second point was I was going to ask, how many of you in this room are looking to exit in the next 2 years? Yeah. I had hoped there would be a lot of hands. How many of you today have a dialogue with decision makers, with the companies, strategic companies that you see as likely acquirers? So quite a few hands, but not quite the same number as the first question. And I think I would challenge you to say that for a variety of reasons, which we can go into if you're interested, that dialogue should commence 2 years before you plan to exit, which many people, entrepreneurs and some investors alike, are surprised by, because it seems like a long time, but it goes by quickly. And if you're not thinking about how you're going to align with a product suite or division or integrate into a company, exactly as was said earlier by Microsoft, then, and you're not doing that 2 years out, then you're pushing out your timeline. Now, of course, our job is to create competitive tension and make sure there's not just one or two strategics at the table, and that you're looking at all your options. But certainly engaging in partnership and product discussions well before an exit is pretty critical. And I think from our perspective, to preserve leverage when it comes to pricing negotiations and timing negotiations, that's pretty imperative to start that timing early. Now, I do have several PowerPoint slides, because we charge per PowerPoint slide. It's a bad joke, but I wanted to make it. But I'm not actually going to go into them, because it was to taunt Marcel a little bit. But we're happy to address any Q&A that people have, and we love technology. We love middle market technology and working between the U.S. and Australia and Europe, and we would love to work with anyone looking at an exit.
So, one of the key questions for a lot of us is, how do we actually begin to engage with potential acquirers? So, Kara, could you talk us through a little bit of that, and then, of course, the other guys chime in on that as well.
Yes, I mean, obviously these two gentlemen are at the coalface, so I'm going to let them really speak to that, because it is a bit particular to the company and to the subsector, and if your service is software, regionally, globally, so there's many dynamics there. But first is to do your research, or as much research as you can do. So there's natural environments to understand where potential acquirers can be, because of course you're out in the market selling product, and where that product is being sold well and where it's not, and where you can ideas around where you can scale and what partners or potential acquirers can help you get there. And one critical point we see a lot, in fact, the reason the firm's called GrowthPoint is because we see a lot where a great technology or a team with the technology just starts to hit that inflection point where they actually are going to really need to scale and to commercialize even more, and roll out a sales team. So not commercialize, but roll out a sales team globally, really kind of hit that inflection point. But using their own balance sheet or trying to raise capital in their given market may not be the right strategy. Maybe the right strategy is to get really close with one of our panelists and actually see that the distribution mechanism for their business to really hit that that key tail is to be acquired or to partner. So yeah, long-winded way of basically saying, know your market well, do your research, and know who those potential acquirers are, because you're selling product with them already 2 years before the event occurs.
I'd add a couple things to that. The first is actually there's a significant burden on you. Significant burden on you. And on behalf of your companies, to know the frame by which the acquirer thinks about their business. You can look across all the acquisitions we've done over the last 3 years and you'll see a pattern. Either impute that pattern as the business strategy or engage with one of the strategics, us, to know what we're trying to get done. Part of the reason I do these kinds of things all over the world is partly that, but it's also partly to sort of ensure that the investing community understands that you have a responsibility to your entities to know what the API to Microsoft is. Okay? I know we're complicated, but you can still figure it out. The second thing is, as a disposition, I want to buy companies before they hit Series B. And the reason is because at Series B, which is typically a scale round, they've got product market fit, they've got revenue, now they want to go scale. There's massive amounts of waste that occurs at that moment. The waste shows up as big venture money. It shows up as time of the founding team to have to sort. And it shows up as inflated valuations that I have to pay for. Okay? So let's just get through that by getting earlier in the conversation. I said that earlier. You really have to engage with us very early. And to Tara's point, if it's 2 years, you got to really, really rethink how you're engaging with the strategics and at the velocity that you have to do that in order for us to be interested in buying.
And just to be clear on that point, so Series A's in the U.S. at least are creeping up to 10 million these days, which is pretty outrageous. So, just think about that in terms of what a Series B means, here versus what you were just mentioning.
Okay, great. So we've gone out there, we've identified maybe 5 or 6 or more potential acquirers. How do we, as representatives of these companies, how do we qualify the acquirer? How do we make sure that they're going to be serious about us, that they've got the money to invest in us, that they'll dedicate the people to really engage with us well? Any thoughts on that, Johan?
Dell proved you don't need the money to actually do the acquisition.
There we go.
The reverse acquisition of EMC. Sorry, go ahead.
Yeah, no. No, I was just going to comment on it. How do you vet the acquirer, right? So I guess the first thing is some of my colleagues here have talked about is do your research, look at the company, look at the track record of what they've acquired and the kind of size and industry they've acquired, and you're probably going to see, do I fit in that or do I not fit in that? Am I going to waste my time trying to pitch myself to these guys? But I think you're then very quickly, again, early relationship, right? You're very quickly going to figure out whether the people are interested or not once you start talking to them. I think that's really the only way you can figure it out. There's only so much time you should spend on all that desk research. It's a people thing, right? And we buy groups of people as much as we buy technology, so the people fit is quite important. And you're going to get a sense fairly quickly, I think, in that dialogue, are these guys really making an effort to make this deal happen, or are these guys just being polite to me and listening to me and maybe picking my brain for technology and kind of holding out? And we try to be upfront about that. I mean, I've been quite upfront with some companies who are like, sorry, but you're not at the stage where we need you to be, or this is just not going to work. Or quite frankly, I've been in a situation where I just didn't see the cultural fit with the people. I mean, they're good people. They're just very different in the way they think and the way they act and the procedures they're used to than what we do. And then we just left it at a commercial relationship rather than acquisition. Everything doesn't have to be an acquisition from our point of view. That's just one option, right?
How much time do you spend looking at your competition, i.e. what they're doing, and maybe you can comment on some of the nuances, alternative strategies, and how much notice do you take of other buyers who are looking at deal flow at pipeline?
I never look at my competitors' buying strategy. Honestly, I don't, because that's their strategy. We have our strategy. We need to execute ours exceedingly well. That's actually kind of almost a shift in the Microsoft. As I've been there for so long, my first job at Microsoft was I was the Novell competitive product manager. My job was to put them out of business, right? That's what we did. That's not how we look at things anymore. We don't drive our business strategy by someone else's business strategy. So that's the first thing. The second thing is, I will engage on something and this is maybe to Tara's point, that her role is to create the auction, to get the maximum return for the target, okay? I will engage in some of those things when I know a competitor's involved, because we'll have to make a decision about whether we want to, not only acquire something, but block something. So that's the only time I really will probably think about the competitor in that way. Every other time, it's really about, we've got our own thing to get done, let's get it done.
Yeah, I'd like to add to that too. We get into that situation too, right? We're a very small industry, if you will. There's only so many companies that do what we do, so we know our competitors pretty well. And it always comes up, well, if you don't buy them, somebody else is going to buy them. And you got to ask yourself, is that really why you want to be acquired by somebody as a blocking strategy? Because you're not going to get the love and the investment that you want after that, right? The other thing is, in some cases, I'm like, you know what? They can have them. Please do buy them, because they're buying a problem more than more than an opportunity.
Quick question: how many companies have each of you guys got on your watching brief that you're basically tracking either the technology or whatever it is that you're interested in?
Well, I have right now probably, as I was saying to the team earlier, I think I have 15 active investigations. And then beyond that, we have many ways in which things get sourced. We track categories, as you saw through the lens, and so we know who we're really sort of interested in. But then quite frankly, because we are so acquisitive now and we're building that reputation as being an acquirer, the amount of inflow is staggering. I've spent the last 5 years sort of engaging with this ecosystem, particularly in the Valley, and I know venture pretty well down there, and I know the early stage companies. It's pretty crazy how much inflow we have. So we actually just have to park a whole bunch of it while we sort through the bigger, more challenging ones that we're looking at now.
So given that amount of, I'm going to jump in here. So given that amount of stuff you guys are looking at, how do we, with New Zealand companies, potentially getting a presence in the U.S., but with New Zealand companies, how do we get that onto your radar? How do we get into that queue or the front of that queue?
Bob Kelly at Microsoft.com.
Great, love that answer.
Know the decision maker, and it is different for different companies. And so what we tend to see, there's the M&A team and there's the ops team. So you need to have, you need a champion inside the company. And the deal doesn't get up without both of those dynamics. It can't just be the M&A team. They're not going to drive the strategy. If they're driving the strategy, Frank, I'd be a little bit worried about the company, but if it's a strategic, so.
Don't confuse my role, by the way. I'm not corp dev. Corp dev transacts. They're the machinery. My role is M&A strategy. And so really, bobkelly.microsoft.com. Not hard.
What's your view from the attractions or demerits of making an investment prior to an acquisition?
We've made that decision that we don't want to have a venture fund. Other tech companies do. But we do actively invest in companies. Okay? The reason we invest is to create strategic alignment and to incent ongoing strategic alignment. That doesn't mean that for example, we recently invested in Cloudflare. In that round, Microsoft, Google, Baidu all invested. So we actively do invest, but we never take a board seat. We don't want a board seat. We don't even want an observer. Literally, it's just create and incent ongoing strategic alignment. And we'll never price around. We're always going to be a small piece of anyone's round.
Yeah, I'm trying to think of an example where we would have done that. I don't think there exists one. Well, there probably is one, but not one that I'm aware of. It's definitely not our style. We'll do commercial partnership distribution agreements. We have about 7 joint ventures with different companies. But that's different from what you're talking about, right? When it comes to acquisition or equity investment, we buy the company, and we just like to buy the whole thing. We don't like to have minority shareholders left and all that. But sometimes happens with the owners and earn-out structures and that kind of thing.
How do acquirers view advisors? Sorry, Karen, you will have a rebuttal.
You're assuming it's going to be negative.
How long do we have?
So in other words, we as representing investee companies could come to you directly, or we could come through an advisor. Any preference?
Some companies can work independently and don't really need an advisor or need minimal advice. I think everybody needs some advice to some degree. if only to feel comfortable and get, have a coach through the process. But I find a lot of smaller technology companies really don't have the sophistication when it comes to the deal-making process of understanding what's going on, and they tend to get paranoid as time goes on or legal discussions go on, and they're not quite sure what to be afraid of and what not to, what's normal and what is trying to sort of get in their pants. So I think advisors can actually be quite helpful.
Extremely.
And I used to be a consultant myself, so I'll be the first to say you got to manage them, keep them under control. There's sorry to say, but there's always scope creep. You do get paid by the slide. So I mean, we used to get paid by the slide, right? But it's true. I used to get paid by the slide, and so there's that's the business model, right? You got to understand what you got and manage them.
Everybody just needs to understand their role.
Yeah.
If everyone's clear about what their role is and relationships have been established, and so you're not dealing with sort of a cold call salesperson, right? Everyone gets it, then it tends to work. And I really want to echo that point that Johan was making there, that the advisor can really, really professionalize the process for an early stage company that doesn't know how to deal with a company like Microsoft. It can be a real asset to the process.
And the advisor should not be the family accountant, because I've seen that in so many cases, right? And the guy also never did a deal, so he's just sitting there reinforcing the fear and the paranoia.
Yeah, so I mean, I'll kind of throw in a couple observations from being on the ground here. The first, I would say, just to be clear, our incentives are actually 90% success fee based. So we don't actually pay for a slide. It's an outcome, just to be clear. But the second thing is, the advisor role is a role of trust. So you want to work with somebody that you can trust, and that you like, who's competent, who gets it, who's the right solution for your problem. Not all advisors can do everything. We cannot do everything. So I think part of it's being intellectually honest as well. So I think that what I see in Australia in particular, and probably in New Zealand a bit too, is this family accountant or family advisor or some sort of tie. So on one hand, I understand that because of the trust factor. But on another hand, the situations in which it's more difficult or deals are more likely to fall over or just be too time consuming tends to be when we have a legal representative or some kind of other advisor in the process who is maybe a little bit above their depth in terms of a cross-border transaction or what a large acquirer is looking for. So yeah, I mean, build trust, but make sure you're getting the right advice for your specific process.
Biggest part of the acquisition sometimes is people. So when you buy a team of engineers or IP creators, sometimes startups have, let's say, a different salary than the corporation, or different culture or everything. I mean, Nelson educates us this morning about Angel de Maria investment. I wonder if you guys have a standard HR proceeding, and if that is discussed at the time of the negotiation, because sometimes suddenly a team gets transferred into other part and suddenly realize, wow, we are doing exactly the same or more, but we are paid less. And so there is a tension there that wonder if you have some comments on that.
We do absolutely look at what their compensation is and understand what level they would come in at the company. So we know we have level bands, that basically our level bands dictate how much you get paid. It's a range, okay? So if we think we have to have somebody at a level 65 that gets paid $150,000 US, then that's how we do it. We sort them that way. The other thing is, tech is a particularly competitive market for talent. And if you have real talent, we find ways to get compensation to them. It happens either through the transaction, there's either monies kept aside for the management team, in which is additional payouts, or it's done as a separate transaction. There's all sorts of things that can get done for the best people, for the right talent, for the truly unique human beings in the world. Not for everybody.
Yeah, it's the same thing for us, basically. It's part of due diligence, and we do discuss that before a deal is closed, to say these particular individuals, how are we going to keep them?
Yep.
Because we also want to make sure that that's what we're buying, right? So we want to make sure they stick around. How do we motivate them to keep them? And we bring them as part of the due diligence discussion, oftentimes.
So thanks everybody very much for your attendance. Thanks very much to the thanks very much to the organizing committee as well for getting such a great panel together for us, and especially thanks to the panelists for traveling and being with us today. Really appreciate it.
That's great.